In 1980, Brazil was widely considered the next global economic powerhouse. With abundant natural resources, a large domestic market, and impressive industrial growth, economists predicted Brazil would soon join the ranks of developed nations. The World Bank even coined the term the Brazilian miracle to describe its spectacular 8% annual growth throughout the 1970s. Fast forward to 2025, and Brazil's economic promise remains largely unfulfilled. Despite brief periods of prosperity, particularly during the commodity boom of the early 2000s, Brazil has spent over 4 decades stuck in what economists call the middle-income trap, unable to transition from a middle-income country to a high-income economy. This stagnation has real consequences for ordinary Brazilians. While GDP per capita reached $11,178 in 2024, it remains less than a quarter of the United States. Nearly 30% of young Brazilians are neither working nor studying, and Brazil continues to have one of the highest rates of income inequality in the world, with the richest 10% earning more than 40% of all income. What makes Brazil's situation particularly frustrating is that the country possesses all the ingredients for success: vast natural resources, a large domestic market of 205 million people, world-class companies in sectors like aviation and agriculture, and a vibrant creative culture. Yet something continues to block Brazil's path to sustained prosperity. Why has Brazil failed to join the ranks of wealthy nations? How has a country so rich in potential remained economically fragile? The answer lies in a complex web of structural problems: chronic low productivity, educational deficiencies, institutional weaknesses, and an economic model overly dependent on commodities. If you want to understand why some nations thrive while others stagnate, and the warning signs other developing countries should heed, subscribe to Capital Cartography for more deep dives into the economic forces shaping our world. Brazil, trapped in the middle. To understand Brazil's economic predicament, we need to go back to the 1950s, when Brazil embarked on a state-led industrialization program. Under the slogan 50 Years in 5, President Juscelino Kubitschek promoted rapid industrial development through import substitution, using protective tariffs and subsidies to build domestic industries that would replace imported goods. This strategy initially delivered impressive results. Between 1950 and 1980, Brazil's economy grew at an average annual rate of 7.4%. Transforming from a primarily agricultural society into a significant industrial power. Manufacturing expanded dramatically, with Brazilian factories producing everything from automobiles to home appliances. Cities boomed as millions migrated from rural areas seeking factory jobs. The 1980s, however, brought this growth model to a crashing halt. The oil shocks of the 1970s, coupled with irresponsible borrowing, led to a debt crisis. Inflation soared to hyperinflationary levels, reaching an astonishing 2,477% in 1993. Economists dubbed the 1980s Brazil's lost decade, but the pain extended well beyond 10 years. The 1990s saw economic stabilization under the Plano Real and the opening of Brazil's economy to global competition. The introduction of a new currency, the real, and tough anti-inflationary measures finally tamed the hyperinflation that had devastated the economy. Under President Fernando Henrique Cardoso, Brazil began privatizing state-owned enterprises and reducing trade barriers, though the process remained incomplete. Then came the commodity boom of the 2000s, when China's insatiable appetite for iron ore, soybeans, and other raw materials drove Brazilian exports to record highs. From 2003 to 2013, under President Luiz Inácio Lula da Silva, Brazil grew steadily again, lifting millions out of poverty. The government expanded social programs while maintaining macroeconomic stability, creating what seemed like a model for inclusive growth. But when commodity prices collapsed after 2013, Brazil's structural weaknesses were once again exposed. Without the cushion of high commodity prices, the economy fell into a severe recession from 2014 to 2016. Since then, growth has been anemic, averaging just 1% annually until the pandemic struck. This boom and bust cycle reveals a fundamental truth. Brazil has never successfully transitioned from a resource-dependent, inefficient economy to a productive, innovation-driven one, the key transformation required to escape the middle-income trap. At the heart of Brazil's economic stagnation lies a profound productivity crisis. While Brazilian workers are among the most hardworking in the world, putting in long hours, they produce remarkably little for each hour worked. Total factor productivity in Brazil has actually declined since the mid-1990s, in stark contrast to emerging Asian economies where productivity has soared. This productivity gap is staggering. A Brazilian worker produces on average about a quarter of what an American worker produces in the same hour. Even compared to other Latin American countries like Chile or Mexico, Brazilian productivity lags significantly. Between 2003 and 2014, the minimum and real wages in Brazil rose by 68% and 38% respectively, while productivity per worker increased by only 21%. What explains this productivity deficit? First, Brazil's infrastructure is chronically inadequate. Logistics costs can reach 12% of GDP, nearly twice the OECD average. Shipping a container from Santos, Brazil's largest port, to Shanghai costs more than shipping it from Rotterdam, despite the shorter distance. Poor roads, limited railways, and insufficient port capacity mean Brazilian goods face a steep Brazil cost before they even reach global markets. The infrastructure deficit extends to basic services. Despite being water-rich, Brazil struggles with water management, with frequent shortages in major cities. Energy distribution is similarly problematic, with frequent outages in some regions. And digital infrastructure lags behind global standards, with internet speeds and reliability well below what would be expected for an economy of Brazil's size. Second, Brazil's business environment is notoriously complex. The World Bank ranks Brazil 125th globally for ease of doing business, behind countries with far fewer resources. Opening a business takes an average of 80 days, compared to just 4 days in countries like New Zealand. The tax system is particularly Byzantine, with companies spending approximately 1,500 hours annually on tax compliance, the highest figure in the world. This complexity creates massive inefficiencies and drives many businesses into the informal sector. Third, Brazil's economy remains surprisingly closed, with tariffs and non-tariff barriers protecting inefficient domestic industries from global competition. The average tariff on imported goods is around 13%, more than double the world average. While this protectionism preserves jobs in the short term, it removes the competitive pressure that drives innovation and efficiency. Brazilian companies, shielded from global competition, have less incentive to improve productivity. Fourth, Brazil invests too little in research and development, just 1.3% of GDP compared to an OECD average of 2.4%. This underinvestment in innovation means Brazilian industries struggle to move up the value chain, remaining trapped in lower productivity activities. The few Brazilian companies that do innovate successfully, like aircraft manufacturer Embraer, are often exceptions that prove the rule. The result is what economists call premature deindustrialization. Brazil's manufacturing sector has shrunk from 30% of GDP in the 1980s to less than 20% today. But unlike wealthy countries, where deindustrialization occurred after reaching high income levels, Brazil's industry has declined before the country became rich, hence premature. Have you ever experienced the frustration of bureaucratic inefficiency? Share your story in the comments. We want to hear how red tape affects real people. Brazil faces a profound education crisis that severely constrains its economic potential. According to the World Bank's Human Capital Index, children born in Brazil today will achieve only 55% of the productivity they could have with full access to quality education and healthcare. The statistics are alarming. In the PISA International Assessment, Brazilian students rank near the bottom among tested countries in reading, mathematics, and science. Only 57% of Brazilians complete high school, compared to over 90% in most developed nations. And while access to basic education has improved significantly, with nearly universal primary school enrollment, quality remains abysmal. The quality deficit begins early. Early childhood education, crucial for cognitive development, remains inaccessible to millions of Brazilian children. Public primary schools often operate in multiple shifts, with students attending for just 4 hours daily, insufficient for meaningful learning. Teacher training is inadequate, with many educators lacking subject matter expertise, particularly in mathematics and sciences. Secondary education faces an even more severe crisis. Nearly 40% of students drop out before completing high school. Those who remain face an outdated curriculum disconnected from the skills demanded by the modern economy. Vocational training, which could provide alternatives for non-academic students, reaches only a small fraction of youth. Higher education presents a paradoxical problem. Public universities are free but highly selective, with entrance exams that favor students from wealthy families who attended private schools. Meanwhile, lower-income students often attend lower-quality private institutions, paying tuition while working full-time, leading to high dropout rates. This educational dysfunction creates a severe skills mismatch in the labor market. Employers consistently report difficulty finding qualified workers, even as unemployment remains high. The most talented Brazilians often emigrate, creating a brain drain that further depletes human capital. The pandemic exacerbated these inequalities. School closures lasted longer in Brazil than in most countries, with remote learning ineffective for millions of students without reliable internet access or appropriate devices. Experts estimate that the pandemic generation may suffer lifetime earnings losses of up to 10%. Most troublingly, Brazil's educational problems have produced a lost generation. A staggering 29% of young Brazilians are neither working nor studying, disconnected from both the education system and the labor market. This nem phenomenon, from nem estudando nem trabalhando, neither studying nor working, represents an enormous waste of human potential. The education crisis both reflects and reinforces Brazil's extreme inequality. Students from wealthy families attend high-quality private schools that prepare them for university, while those from poor backgrounds receive inadequate public education that limits their future prospects. This educational apartheid perpetuates inequality across generations, trapping millions in low-productivity jobs. What do you think is the most urgent reform needed in education? Share your thoughts in the comments below. Despite these entrenched challenges, Brazil possesses significant strengths that could form the foundation for economic transformation. The path to escaping the middle-income trap, while difficult, is not mysterious. It requires addressing the fundamental causes of low productivity, inadequate human capital, and institutional weakness. First, Brazil must dramatically improve its business environment. Tax simplification is particularly urgent, replacing dozens of federal, state, and municipal taxes with a streamlined value-added tax system. Regulatory reform could reduce the bureaucratic burden that suffocates entrepreneurship and innovation, and trade liberalization would expose sheltered industries to competitive pressure while reducing input costs for all sectors. Second, education reform must focus on quality, not just access. This means investing in teacher training and evaluation, extending the school day, modernizing curricula to emphasize critical thinking rather than memorization, and strengthening the connections between education and the labor market. Successful examples exist within Brazil itself. Schools in Sobral municipality achieved remarkable improvements through focused interventions. Third, infrastructure investment needs to be dramatically increased and better targeted. Public-private partnerships, properly structured, could help address the estimated $150 billion infrastructure gap. Priority should go to logistics projects that reduce the Brazil cost and digital infrastructure that enables technological adoption across the economy. Fourth, innovation capacity must be strengthened through increased R&D investment, better university-industry connections, and support for high-potential startups. Brazil produces world-class research in agriculture through Embrapa, the Brazilian Agricultural Research Corporation. This model could be replicated in other strategic sectors. Fifth, inequality must be addressed through both pre-distribution and redistribution. Pre-distribution means creating more equal access to quality education, land, credit, and other productive assets. Redistribution requires tax reform that shifts the burden from consumption to income and wealth, along with effective social programs targeted to the most vulnerable. Finally, institutional strengthening is essential across all areas. This includes judicial reform to increase efficiency and predictability, civil service professionalization to improve policy implementation, and political reforms to create incentives for long-term thinking rather than short-term patronage. Brazil has achieved remarkable successes in specific areas that demonstrate its potential. Its agricultural research transformed the supposedly infertile Cerrado savanna into one of the world's most productive farming regions. Embraer became the world's third largest aircraft manufacturer through strategic innovation. The central bank's payment system PIX has leapfrogged many developed countries in financial technology. These examples show that Brazil can overcome its middle-income trap through strategic reforms and long-term commitment. The demographic window is still open. Brazil's working-age population will continue growing until the early 2030s, providing a potential productivity boost if properly harnessed. If you've enjoyed this economic deep dive, subscribe to Capital Cartography for more insights into the forces shaping our world. Next week, we'll explore how Vietnam is navigating its own development challenges. Until then, Ate Logo.